Hey guys, I hope you're doing well. Welcome to this revision marathon session for the ACCA SBR. This is Lukman Rafiq here. I am sure a lot of you people know me already and have attended the sessions that I've conducted earlier also. My agenda for the session of today is I shall be going around with few past paper questions on the SBR, and my focus would be to do the practice questions so that you could have an idea that how to answer the questions and how to deal with the scenarios. I would have ideally loved to do the questions on the ACCA CB practice platform, but unfortunately, the CB practice platform is not operating properly. I've been trying for it for a while back, but unfortunately, it's not working well. So I would have to ultimately do it using the Word document and the Excel document, which is unfortunate, but again, you can't help it out. The reason being that the ACCA CB practice platform is not working properly. So let's just start off. I've got in front of me one of the questions that I will actually start discussing. And this is a question on, this is a question from the past papers. Just wait a bit. Okay. What I will actually try to do is that I'll try to actually attempt this past paper, which is the December 2021 past paper. I would try to do this paper. I would take you people through so that we could understand, we could see that how the different questions are to be answered. So I have got this question number, this section A in front of me. As you know, with respect to the SBR section A, there are usually two questions which are being examined, and the total section A carries 50 marks. And out of those two questions, one of the question is usually of 30 marks, one of the question is of 20 marks. So the first question that I have in front of me is about Chuckle Company. And you know, the first question is usually for the consolidation. So we're going to go through this question. We'll try to see how exactly do we need to answer the question. So it says Chuckle Company. What does it say? It says Chuckle Company has an equity interest in a number of entities, including Green Company. Chuckle Company has recently acquired additional equity in Green Company, and the directors are unsure as to how this may impact upon their consolidated financial statements. The year end is 31st March each year. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Initial acquisition of Grin, initial purchase of 30% of Grin on 1st April 2. Subsequent acquisition of Grin Company, subsequent 18% purchase of Grin, and the purchase of share option on 1st April 6. And fair value of net assets at 1st April 6. The information should be used to answer the requirements within your chosen response options. So obviously, the response options that are given in this question are word-based and the Excel-based. Now let's just try to understand the requirement of the questions, that what are the different requirements. It says draft an explanatory note to the directors of Chuckle Company to address the following issues. So what do you have to do? You have to address the following issues. What are the issues that you have to address? Try to understand this thing. Why it was correct to initially classify Green Company as an associate as opposed to a subsidiary on 1st April 2002. So there is a 4-mark requirement where he's asking you that why was it appropriate to classify an investment as an associate instead of subsidiary. The second thing is that how Green Company should be accounted for as an associate using equity method in the consolidated balance sheet at 31st March 2006. Your answer should also explain how revaluation of land at 1st April 5 was accounted for and include all relevant calculations. Whether the classification of Chuckle Company's investment in Grid Company should change on 1st April 6. So there is some event probably happening on 1st April 6, and you have to answer that question. Then there is this part B, which is on the assumption that Chuckle obtains control on 1st April 6. Explain how the fair value of non-current asset and current asset at acquisition including any deferred tax adjustment, should be calculated, and how goodwill or gain on bargain purchase should be calculated at 1st April 6. Your discussion should include a brief description of accounting treatment arising from additional purchase of equity investment in the green company. Now, you see, this is a question that has got multiple parts. So what we now need to do is that these 30 marks need to be done and handled in a proper manner. So first of all, one of the part is that why it is correct to initially classify green as an associate as opposed to subsidiary. I'm going to open up this Word document also, and I would say Shakal company. So the first part is why it would be, why it is going to be appropriate to classify it as an associate, right? That's first question. Then the second question in addition to this is that how it should be accounted for using equity method at 31st March 6. Your answer should explain how revaluation of land at 1st April was accounted for. How it should be accounted for at 31st March 2006 and how revaluation of land was accounted for. Now let's try to see this. Let's try to understand this. What I would want you people to do is that it is talking about the initial acquisition of grain in exhibit number 1. Then if we move a bit forward, so it's actually talking about the subsequent acquisition of grain company. So there is this initial acquisition, there is this subsequent acquisition. Then there is this exhibit number 3, which talks about the fair value of net assets of grain company. Then there is this exhibit number 4. In fact, no exhibit number 4, it's directly then going to go on to the next question. So let's try to go through this initial acquisition of grain company. Let's try to answer the first requirement. So can you just go through it and can you just let me know what's going on? Okay, let's try to discuss this. It says Chakal on 1st April 2002, Chakal company acquired 30% of the equity shares of Grain Company. The consideration consisted of $100 million cash. The consideration consisted of $100 million cash. The carrying amount of the net assets of Green Company on 1st April 2002 were $286 million, which was the same as their fair value. Since then, Green Company has been correctly treated as an associate in the consolidated financials of Chakal. The remaining 70% of the equity of Green is owned by few other investors, none of which own more than 10% of the equity of Green. Analysis shows that all shareholders have voted independently in the past. Chakal and Green share some key management personnel. Now, let's just try to discuss this thing, that how exactly are we going to write down the answer to this question. First of all, when we talk about the concept of associate, associate is an entity upon which investor exercises significant influence. Upon which investor exercises significant influence. And you would say significant influence is the power to participate in the decision making process. Significant influence is the power to participate in the decision making process. Whereas a subsidiary is an entity, that is controlled by the investor. Control, an entity is said to have control over the other, if it is able to demonstrate all of the following. It has power over investee. It has exposure and right to the variable returns of the investee. It has the ability, it has the ability to exercise power. Now, usually the power is demonstrated through the ability to undertake economic decisions for the entity, for the investee. In the current scenario, although Chakal Company owns 30% of the shares of Green Company and no other investor owns more than 10% shareholders, indicating that Chakal may have the highest shareholding. However, what would happen is that what next is going to happen? Sorry. Now, so however, there are apparently no indications that Shakal controls the green company. Having shared key management personnel does not guarantee having shared key management personnel does not guarantee control, and instead demonstrate participation. Therefore, based on above, the investment in green shall be considered as associate and not subsidiary, right? So by virtue of having common directors does not mean that you are the owner. By virtue of having common directors does not mean that you are the owner. Yes, we do have a shareholding, we do have substantial shareholding, but that does not make us the owner. So that's what you would have to keep in mind. So that's how you are actually going to answer this question. We'll move on to the next part of the question. And with respect to next part of the question, the examiner says that you have to, okay, you acquired it for 100 million cash. Carrying amount of net assets on 1st April was 286 million. Then the third one of them is basically, here is more information. So what is the requirement of the question? The requirement of the question is that how green company should be accounted for as an associate using equity method of accounting at 31st March 6. So that's what you have to comment on. So I'll just open this in front of you so that you could just review it, and let's give it a try, please. Okay, guys, so let's just start off. It says Checkle Company acquired a further 18% of the shares of Green Company's equity on 1st April 6. The consideration for further 18% of the equity shares on 1st April 6 was 66 million in cash. The fair value of the original 30% of the equity interest was this. The carrying amount of the net assets on 1st April 6 was 348 million, which included some land which had been revalued upwards by 15 million and correctly accounted for on 1st April 2005. So your net assets were 348 million. Now, deferred tax at 20% had also been correctly accounted for on the gain in the individual statements. The rest of the increase in the net assets was solely due to profits. Green Company had paid no dividends during this period. Remaining 52% of the Green Company at 1st April 6 is owned by few other investors, none of which own more than 10% of the equity of Green. On 1st April 6, okay, now whatever that has happened on 1st April 6, I would discuss it later on because right now I'm accounting for 31st March 2000 X5. Now he's giving you non-current asset, current asset, deferred tax, other liabilities, so and so, so and so. Included within the non-current assets was the land which had been previously revalued upwards by $15 million on 1st April 5. Carrying amount of this land was so and so, but this value was assessed to be so and so. Okay, now what am I actually gonna do? I'm gonna say that let's just try to do the accounting for this associate accounting for this Checkle Company. Now what does it say? The requirement of the question is that how it should be accounted for at 31st March 6. At 31st March 6 is before the further acquisition, and how revaluation of land was accounted for. Now let's try to understand this. The first thing that you need to understand is that basically the first thing that you need to understand is that the associate shall be accounted for using equity method of accounting. Under the equity method of accounting, so what does it say is the associate shall be accounted for using equity method of accounting. Under the equity method of accounting, the assets, the associate is not consolidated. Instead, it is presented as a single line item in the consolidated SOFP, and its share of profits and OCI are presented as line items in the consolidated statement of comprehensive income. With respect to the investment, the SOFP carrying amount of the investment shall be, I would say, Appendix 1. Or you could say reference 1. For the statement of comprehensive income, which is the SOCI. For the statement of comprehensive income, which is the SOCI. For the statement of comprehensive income, a share of profit of reference to shall be presented as income from associate, and share of other components of equity shall be presented for this reference 3. So what have I done? I've drafted the answer. I've let the place for the calculations because my question actually had this Excel response option. So I will actually go for it. Now, what will I do in the Excel? So let's just try to understand this. So when I talk about the Chuckle company, the calculation number 1 is basically at 31st March 2000 x6. Cost of investment less fair value of net assets, percentage share, add share of post acquisition increase in net assets. How? Net assets at reporting date, net assets at acquisition date, the increase, and then share of Chuckle. So cost of investment as at 31st March x6. Now let's just try to understand things. That how are we going to do it? So from the question you would see that when you invested for how much? You invested 100 million for cash, right? You invested 100 million for cash. When you acquired it, it was having a net assets of 286. How it's written over here. And at 31st March 2006, it has got how much? It has got 348 million. It has got 348 million. How much do you have? 348 million. So there was this increase that was 348 million. Now, so how much is actually the increase? Let's try to understand this thing. So the increase is going to be the difference between this and this. The difference between this and this is going to be considered as increase. The percentage is going to be what? 30%. Hence, what actually happens is this into this. This into this. So resultingly, what would happen is that you would say this plus this. 118.6 is going to be considered as investment. 118.6 is going to be considered as investment. Right? So when you would actually recognize the cost of investment, when you would recognize the investment in a statement of financial position, this is the value at which you would recognize the investment. Is that okay? Now, let's talk about the statement of comprehensive income. So what actually happens is that the increase in net assets is basically 62. The increase in net assets is 62. So how much is the increase in the net assets? The increase in net assets is 62. Now what you need to do is that you need to see how much of the increase is due to profits, how much of the increase is due to the revaluation. So for that you need to understand basically the revaluation gain is 15 million. The impact of deferred tax at the rate of 20%. We were being told how much was the revaluation? The revaluation was 15 million, right? So impact of deferred tax, which is gonna be this, multiplied by 20%, is 3. So net increase recognized in OCI would be this minus this. Share of associates other component of equity is gonna be this multiplied by 30%. Is gonna be this multiplied by 30%. So share of associates other components of equity is gonna be 30%. So it's gonna be 3.6. What? It's gonna be 3.6. Now, with respect to the second one, which is how much is going to be the increase in net assets and how much is due to profit, less the increase due to other component of equity. Is gonna be 12. Increase due to profits is this. Share of profit is gonna be this into 30%, right? So hence what happens is that this is another one of the thing that needs to be recognized in your company's financial statements. Now I'm actually going to zoom it out for a minute so that you could just see. So kindly just have a look at it and let me know if you people understand what have I done. Okay, your question, how did I get 3.6? Let me just guide you. This 3.6 is basically your share is 30%. Your share is 30%, right? So your share is 30%, is 3.6 is 30% of that. Now what next are they gonna do now? So basically we did all the calculations actually, and we are now supposed to 118.6. This one is gonna be 15 million. And this one is gonna be 3.6 million, which is reference 3. So that is how you're gonna actually answer the question. So I repeat, this is how you will answer the question. The accounting for revaluation is such that revaluation gain is recognized in the OCI. The deferred tax impact arising due to revaluation is adjusted from the OCI. Hence, instead of 15 million revaluation, 15 million revaluation reserve, a deferred tax impact of 3 million is incorporated, leading to net revaluation reserve of 12 million to be recognized. Right? You get my point. This is what it is gonna be. I mean, this is what it is gonna be. Now, let's move a bit forward and let's try to discuss further. There was this another requirement of the question, and that was whether the classification of Chuckle Company's investment in Grin should change on 1st April 6, number one. Number two, on the assumption that it obtains control, how the fair value of the non-current and the current assets at acquisition date should be calculated. So what happens is that you have to apply whether the classification of Chuckle Company's investment in Grin should change on 1st April 6. Okay. Whether classification of Chuckle Company of Grin Company's investment should change or not. That's what you have to answer. So I'm just opening up the question in front of you again. Can you just try to do this, please? Yeah, can you just try to do this? Can you just try to do whatever that you know about? Okay, now here what we need to do is that we now need to talk about this specific one. It says on 1st April 6. On 1st April 6, Chuckle also acquired some share options in Green Company exercisable anytime until 31st March 7. The exercise price of the options was just above the market price of Green Company shares. Green has been profitable for a number of years and the share price has been on upward trend which is expected to continue. Chuckle would increase its ownership to 60% should it increase its exercise its right. It is believed that there will be additional cost savings should the additional shares be acquired as decision at the board level could be made more efficiently. Now, what happens is that this is one area of the consolidated financial statement accounting, which is basically there is something which is called potential voting rights. I bet there is something which is actually termed as potential voting rights. Now, what exactly do you mean by potential voting right? Let me just try to explain to you. Potential voting rights are instruments PVR are instruments which, when exercised, so what is the potential voting right? Potential voting right are those instruments which, when exercised, can provide additional shares / voting rights of the investor. The potential voting rights shall be considered in the evaluation of control if these potential voting rights are substantive. PVR are substantive when it is highly probable that they shall be exercised. In the current situation, although the options may not be immediately exercised, but it is likely that options will be exercised as it is likely to become as exercise price is likely to become. As exercise price is likely to become lower than the market price. Furthermore, it will be beneficial for the Chuckle company to obtain control. Hence, on the basis of this, the existing (48% shareholding) and the PVR and the voting and the options, if considered together, shall be assumed to give control to the Chuckle company and hence Shackle Company should recognize its investment in Grin as a subsidiary. Do you get it now? It's a whole story about the potential voting rights. I repeat, it's the whole story about the potential voting rights that you would have to consider. It's a whole story about the potential voting right that you would have to consider. Now let's move a bit forward and let's discuss further. The next requirement of the question was that how the fair value of non-current asset and current asset should be calculated and how goodwill or the gain on bargain purchase option will be calculated. Your discussion should include a brief accounting treatment arising from additional acquisition of 18% in Green Company. So there are two aspects. One of them is how would you establish the fair value? And the second thing is that how goodwill or the gain on bargain purchase should be recognized. So these are the two things that you would have to consider, right? Okay, let's try to understand them. This is something about the company. Plus, let's talk about this. So can you just do two things? First of all, how to calculate the goodwill, and plus how to establish the fair value. Can you give it a try, please? Yeah, can you give it a try, please? I want you to calculate the goodwill, plus I want you to comment that how the fair value of current asset, non-current asset should be calculated at the time of acquisition. Okay, guys, so let's just try to see this. It says the carrying amount of the net assets of Grin on 1st April 6 were as follows. Non-current assets, current assets, deferred tax, other liabilities. Included within the non-current assets was the land which had previously been revalued upwards by 15 million. Okay, yes, we know it. The carrying amount of this land at 1st April was 50 million, but its fair value was assessed to be 60 million at 1st April 6. Current assets include finished goods with a cost of 84 million. The fair value of these goods is 131 million. On 1st April 6, the directors of Chuckle also identified that Grin had an internally generated database of customers who were likely to be interested in purchasing their products. Although there were no contractual or legal rights associated with this database, a professional expert has estimated that competitors of Grin Company would be prepared to pay $5 million for this database. Grin Company has not recognized the database as an asset within their individual financial statements. The current tax rate is 20%. The rate should be applied to any fair value adjustment deemed necessary. The Chuckle Company has a policy of measuring the non-controlling interest as the proportionate share of the net assets. Now let's just try to have a discussion of all this. Basically, you are going to write it down like this, that the requirement was how the fair values of the current and non-current nature and the non-current columns assets shall be determined. How exactly are you going to do it? Just try to understand this. Basically, you would say that at the time of acquisition, all the identifiable assets and liabilities of the subsidiary are to be measured at fair value. The fair value shall be determined using the principles laid down in IFRS 13 fair value measurement. With respect to IFRS 13, the fair value is the exit price, that is the price at which assets could be sold or liabilities could be settled between market participants. What do we mean by market participants? Between market participants in an orderly transaction. Now, what next is going to be there? With respect to land, it shall be its fair value is 60 million, and hence its valuation should increase by $10 million. Its valuation should increase by $10 million. The increase of $10 million would lead to increased deferred tax liability of $10 million multiplied by 20% is equivalent to $2 million. For the inventory, its NRV should be estimated and an adjustment to the carrying amount of the shall be made. This would mean that inventory valuation would increase by 131 minus 84 is equivalent to $47 million. This increase will also give rise to deferred tax liability at 20% and will reduce the net assets by 47 into 20% is equivalent to 9.4 million. With respect to the customer database, although it is internally generated for grain company, but it is okay. You see, what happens is that when you acquire a subsidiary, I repeat, when you acquire a subsidiary, so what actually happens is that you measure all its assets to fair value, all its assets to fair value. I repeat, when you acquire a subsidiary, you remeasure all its assets and liabilities to fair value. So normally, if it would not have been an acquisition transaction, it would have been an okay thing. But here it's an acquisition transaction. Here it's an acquisition transaction, right? Now, but it is externally acquired asset for the Chuckle company and hence should be recognized at fair value, which is the value suggested by the valuer. A taxable temporary difference equal to 5 million into 20% is equivalent to $1 million shall also be recognized. right? Okay. What else is there? In fact, yes. Now, so basically, this is how you would actually apply for it. Now, there is this last requirement to the question. And what is the last requirement to the question? Let's try to see. It says that how goodwill on bargain purchase should be calculated. Your discussion should include brief description of accounting treatment arising from additional purchase of 18% equity. How goodwill should be calculated. How goodwill should be calculated. Now, when we talk about all of this, so you would realize this thing. This is the scenario of a step acquisition. This is the scenario of a step acquisition. Under this case, there is an existing interest of, there's an existing interest of 30% that Chuckle company has, and it has acquired additional 18% shareholding. This additional acquisition would lead to the recognition of goodwill in such a manner that existing investment in associate shall be derecognized and the existing interest of 30% shall be remeasured to the fair value. The cost of investment shall include fair value of the existing interest and the cost of further acquisition. And the cost of further acquisition. Now, let's just try to discuss and let's just try to see this. The goodwill calculated in reference 4 is, so now we're going to refer it to number 4. Number 4. Now, the goodwill calculation shall be like this. Fair value of existing interest. Cost of further acquisition. You've got fair value of existing interest, and then there is this cost of further acquisitions. So how would we know all this? Let's just try to see. The fair value of the original 30% interest was 127 million. The cost of further acquisition was 18% was acquired for 66 million. Then you would say non-controlling interest, which is fair value of net assets at the rate of 52%. You would say why? Because 30% was owned by you. You have acquired additional 18%. Although you are at 48%, but you still control. Right? You still control. Now, fair value of net assets. The net assets, fair value adjustments, then what actually happens is that you've got land, you've got inventory, you have got the third one of them is basically about the customer list. Deferred tax liability. So the fair value of net assets right now was 348 million. The fair value adjustments with respect to land is 60 minus 50. With respect to inventory is 131 minus 84. With respect to customer list is 5 million. The deferred tax liability is gonna be minus 20%. Sorry, minus the sum of all of this into 20%. Hence, what actually happens is that this is what it is going to be. If we try to calculate the goodwill or the gain on bargain purchase, it's going to be like this. But there is one element remaining, and that is basically this multiplied by 52% gives you the non-controlling interest. So hence, what actually happens is that you have got 2.152. I repeat, you have got 2.152 as your goodwill. I bet you have got 2.152 as your goodwill. So the goodwill is gonna be 2.152. Right now. So you would say that the goodwill calculated is 2.152 million. Now, basically, this is how you would be doing it. Now, there is one more thing, which is we had an associate that was being recognized. We need to see how do we recognize, how do we reverse the associate. So that is also something that you would have to actually recognize. The existing carrying amount of associate was, yeah, that's what I'm actually going on to. Now, when you have the step acquisition, you don't calculate the gain, Torat. If you have a control change, you don't calculate the gain on acquisition. That's basically just the goodwill that you calculate. Had it been, let's say, already a subsidiary, then you would have acquired additional shareholding, then you would have calculated a gain on acquisition. But in this scenario, no, you don't. So you would say the existing carrying amount of the associate, which we did calculate in the first part, was 118.6. Was 118.6, and the fair value of the investment was 127 million. The investment in associate shall be derecognized and again equal to 127 minus 118.6 is equivalent to 8.4 million shall be recognized. Again equal to 8.4 million shall be recognized. For the amount that was pertaining to the revaluation and was held in other components of equity cannot be reclassified to P&L and instead shall be recognized and instead shall be transferred to the retained earnings. So you had the associate, you have to derecognize the associate now. And for you to be able to derecognize the associate, you have to remove the impact of associate in the other components of equity, whatever the impact in the balance sheet were. So whether that be pertaining to revaluation reserve, whether that be pertaining to investment, etc., that needs to be removed now. Right? So we are done with this question, the name of which was Chuckle Company. Now, let me know if you people have got any question on Chuckle Company. Let me know. So we are done with this question, the name of which was Chuckle Company. I have comprehensively gone through the discussion area. I've comprehensively gone through the workings also. So let me know if you have got any questions on this. Okay, Maika Koda, I'll just tell you. See, what happens is that if you already have control and you acquire additional shares of a company, then that's basically a subsidiary in which you are acquiring more shareholding. So if there is a subsidiary in which you are acquiring additional shareholding, that means you now have to calculate the gain or loss on a step acquisition. But if there was an investment which was not a subsidiary and you convert that into subsidiary, so that's simply an acquisition. That's simply a goodwill case. Okay, good enough. So is everyone okay till now? Okay, you want to know the general entry? I'll just let you know what is the general entry going to be. investment in subsidiary, debit by 127. Investment in associate, credit by 118.6, and the P&L, or you could say the income statement, is gonna be credit by 8.4. It's gonna be credit by 8.4. So this is how you're gonna recognize it. Do you get it now? Okay, lovely. Good enough. Okay, any head. I mean, like it could be other income, it could be anything. It's other income, it could be any head. Right? Okay, good enough. So I'm gonna take a short break of 10 minutes. And as soon as I come back, I will have a one-to-one discussion with you all. And in that discussion, I would actually be solving whatever queries that you people have. I will be taking you people through all the queries. I'll be taking you people through all the queries, whatsoever query that you have. I'll be dealing with those queries one by one. So we have a short break. The time right now is 7:50 p.m. So we are resuming at 8 p.m. Right? So we're resuming at 8 p.m. Okay, guys. So I have got, I mean, like there are a lot of you people here, and it would be great if you people could actually come up with your queries, come up with your issues, come up with your problems, and any specific questions that you have. I would be more than happy to specifically answer them. So I would like, because I know some of you would be okay to unmute, some of you would be unokay to unmute. Whatsoever that is, I am perfectly fine. I'm okay if you unmute. I'm okay even if you don't unmute, right? So I've got with me Amna Razak. Amna Razak, you have got any queries, any issues, any area that you're struggling with, anything that you would like to ask? Okay, probably I might start from the end. Vivek Sethi, you are with me. Is it, do you have any queries? Do you have anything to ask? Do you have any issues to discuss? Okay. Olajumoke Akhanle. I hope that I'm pronouncing her name correctly. I'm sorry about it. Do you have any queries? Do you have anything to ask?
No, I'm fine.
Okay, so do you get to see how did I answer this question? Was it helpful for you?
Yes, yes. Most times I always go back to the recorded message. So
Lovely. Okay. Mike Koto, do you have anything to ask? Any questions, any queries? I can't hear you. Okay, good enough, Mike. Just keep on focusing. Just keep on preparing for this June session. Inshallah, you'll be able to do it, inshallah. Okay, Esther Suka, I'm just gonna come to you. Don't worry about it. I'm just gonna answer you. Mayank Khatri, do you have anything to ask? Yeah, Mayank Khatri, do you have anything to ask? Okay, America Drakes, do you have anything to ask? Yeah, America Drakes, do you have anything to ask? Okay, Happy App, when are you attempting the paper? Okay, I've got Grishma Jiju. Grishma Jiju, do you have any questions? Do you have any topics to discuss? Do you have any queries? Okay, lovely. So how is your preparation? Okay, lovely. Okay, Esther Suka, you have a question that I joined in very late. I missed most part of the discussion. Kindly explain how to calculate the goodwill and net assets when doing the group accounts. Okay, the recording for this session would be made available, Esther. So you could just review the recordings for the session. Probably it's gonna be available tonight only. Let me know if you have any other areas to discuss, any other queries that you have.
Okay, thank you. I'll check the recording, but I don't know if you have covered IS 19 on how to compute the payment for the employees that leave halfway through the year.
Okay, you see, from the perspective of the exam, if the employees, they leave halfway during the year, the examiner would clearly give you the settlements, the amounts that have been paid to the employees. Like usually from the perspective of the exam, there are two types of questions. One of them are the questions for the defined contribution plan. One of them are for the defined benefit plan. And when you actually account for the defined contribution and defined benefit plan, what happens is that the examiner gives you the details. I mean, like if you are talking from the practical perspective that how to calculate, it's far from the examination's perspective. So, but if you have any specific examination question in mind, just let me know.
Okay. There's one that I'm currently looking at. I think it's an old exam paper. It's okay, let me just pick it. Okay, it's an old exam paper for 2019. It's a hybrid paper, September and December. So it was a question to do with Dig Wire Company. So it was the question 2, or sorry, section B, question 3, and part C.
Okay, let me know which question. March, June 2019.
No, the September, December 2019 hybrid paper.
This is the one, right?
Yes, that one.
Which question?
And then question number 3.
Yeah, DigiWire, right? Okay, so what is it? It's
yes, DigiWire.
Okay, which one? This one, right?
It's this. Yes, the section C.
Okay, it says DigiWire. Okay, it's actually a current issue scenario. I have a recording for this question. Also, I've done it in the past. Would try to share that after the class.
Okay.
But I'll just explain. It says DigiWire company provides a pension plan for its employees. On 1st September 6, DigiWire has decided to curtail the plan and limit the number of participants. The employees were paid compensation for the plan assets. and some received termination benefits due to redundancy. Due to curtailment, the monthly service cost changed from 9 million to 6 million. The relevant financial information relating to the plan is as follows. So your 1st January 6th, the net defined benefit liability is 30. 36 at 1st September 6th, 39 at 31st December 6th. Now, what actually happens is that here it says we decided to curtail the plan and to limit the number of participants. The employees were paid compensation from the plan assets and some received termination benefits. Now, here the examiner has not given to you that how much termination benefits were given. So, but I would just give you a roughly idea. So it is like, for example, present value of defined benefit obligation, fair value of plan asset, right?
Yes.
Let's say before, after. It's 100, it's 90. Let's say this is 70. Let's say this is 70. This is gonna be, let's say, 62. Now, what would happen is that you had a defined benefit obligation of 100 and the plan assets to be 70. So the defined benefit liability was 30. Defined benefit liability was 30. Here, when you go about it, it has become 28. So you see, the defined benefit liability has reduced by 2. How are you going to recognize all this? You would say cash credit by 8. The defined benefit obligation debit by 10 and the P&L credit by 2. So generally speaking, all that we do is that we recognize this gain on settlement and curtailment. This gain on curtailment in the P&L, that's what we recognize. Now, this specific question was not in this context. This was majorly a question that discussed how the accounting treatment is going to differ from now and under the proposed changes of IS 19. So it was the current issue scenario. It was not like this. I've solved this question. I'll share with you the recordings. I've solved this question earlier.
Okay.
Right? But
right,
if it would have been the gain or loss on curtailment, this is how you would have recognized it. Okay, can you just let me know what other areas do you have queries with? Yeah, what other queries do you have, please?
Okay. Okay, just a moment.
Yeah, sure, I can wait. No issues.
Okay. Paper ID. Statement on accounting treatment. Research on consumption. The intangible aspect. Intangible aspect. Okay. The other question I would have is on IFRS 15 revenue from contracts with custom.
Which attempt?
Okay, this one is paper. This one is again December 2020.
Which question?
December. Question 2.
Yes. Which part? Yeah, which part, please?
So question 2A.
Okay, this one. Discuss appropriate accounting treatments which the student company should adopt for all issues identified above and the impact upon gearing, right? Now, let's talk about this one. It says cash advance from Budster Company. On 27 September 9, stunt company's director asked the accountant to record a cash advance of 3 million received from a customer Budster Company as a reduction in receivable. So you've received advance from the customer. So all that you have done is you have said cash debit by 3. Receivable credit by 3. That's what he has asked him to do. Now, the accountant has seen an agreement signed by both companies stating that $3 million will be repaid to Budster Company in 4 months' time. Okay. The finance director argues that proposed accounting treatment is acceptable because payment has been made in advance in case Budster wishes to order goods in next 4 months. However, accountant has seen no evidence. Okay, so basically, this is an inappropriate treatment. There is actually a loan. The reason for them giving us the payment is not under the normal trading terms. It's actually a loan because it is due to be repaid. So what you should do is that you should say receivable debit by 3 million again. And the liability or the loan is going to be credited by 3 million. So that's what you are going to do with respect to this. The correct accounting treatment for this one is going to be that you would recognize what? You would recognize this liability, which is the payable. Next is the preference shares. So when I talk about the preference shares, it says on 1st October, CEO and finance director each paid $2 million cash in exchange for preference shares from a stent company, which provide cumulative dividends of 7% per annum. Generally speaking, if there are preference shares which provide cumulative dividends, they are classified as liabilities. These preference shares can either be converted into a fixed number of ordinary shares in 2 years' time or redeemed at par at a choice of the holder. Finance director suggests that accountant and preference shares should be classified as equity because conversion is into fixed number of ordinary shares on a fixed date and conversion is certain so and so so and so. The answer is it's neither equity, it's not liability, it's actually a compound financial instrument. And you should recognize both equity, you should recognize both liability. I repeat, it's a compound financial instrument. You should recognize both equity and liability. You should recognize both equity and liability. Right? Deferred tax asset, the company includes a deferred tax in the statement of financial position based on losses incurred in the current and the previous 2 years. Finance director has asked the accountant to include deferred tax asset in full. He has suggested on the basis that a stunt will return to profitability once its funding issues are resolved. So the answer is that the deferred tax asset on unused tax losses shall only be recognized to the extent that such losses could be offset. So you cannot recognize the deferred tax asset under this situation. Why? Because you are not certain to be returning to profitability. There is not an expectation of the entity coming back to the profitability soon. So on this basis, you need not to, I repeat, on this basis, you need not to actually recognize the deferred tax asset. Right? Okay, so we are done with this specific one, Esther. I hope that you do understand this. Now, let me know what other queries do you have, Esther Suka. Thank you for asking these questions because I'm sure others would have also benefited out of it.
Okay, for now, I'll wait for the others to ask as well. Then I'll check the ones that I see. I'll text in the chat box.
Okay. I've got a few chat questions. Mayank Khatri, for the current issues and practice and prepare ethics question, I've got some videos with it for it. Are you in any of the WhatsApp group? In fact, for everyone who has joined in, we'll just share some messages to them. So don't worry about it. Okay, Alicia Daniel, can you please briefly discuss embedded derivatives? Okay. Also, okay, embedded derivatives. I have a video. I mean, I shared some time back with somebody. I'll just share it with you again in a while. Just allow me, as soon as the class gets ended up, I will inshallah share this video on the embedded derivatives. I have a video prepared on current issues. I've got video on the embedded derivatives. I'll be sharing with you people on them. So that is what it is going to be. Okay, let me just, in fact, I've identified this video on embedded derivatives because a lot of you people were asking for it. Okay, I have got, yeah, Lasana, don't worry, I'm just gonna come on to you. Alicia Daniel, do you have any other query? Okay, yeah, Lasana Jetta, how can I help you? I mean, like, what query do you have? Yeah, Lasana, please, you could unmute yourself, lady.
Okay. Like I was saying, I said I need a video on page accounting, and also to distinguish where a question asks you to distinguish what is a financial instrument, distinguish it from equity, like the question that you have just shown, preference shares, which we said it is a compound financial instrument. So in a situation where the examiner asks you to distinguish equity from liability, all that stuff.
Okay, let me just guide you. Yes. If I mean, like, just let me know if this is what exactly you were asking for. What I'm able to understand is that probably you are asking a question that how can I distinguish between whether it's a compound financial instrument or not, right? That's what you're asking, right?
Yes, that is one. the second point is, how to distinguish equity from liability.
Okay. Okay,
Yes.
the first one of them is that whenever you issue an instrument and when you give counterparty means the person to whom you're giving the issue instrument are right to decide whether they want it to be redeemed for cash or whether they want it to be converted to equity shares. Like for example, when you have got a convertible bond, what happens under the convertible bond? Under the convertible bond, you give the bondholder the right. The bondholder can actually opt for conversion into equity shares, or the bondholder can go to actually have the bondholder can go for the cash, right? So when you have given the counterparty a decision to choose, then that's going to be considered as a compound financial instrument. That's number one thing. Now, second thing is that how do we distinguish between equity and liability? So the major distinguishing factor between equity and liability is that for the equity, there is an absence of obligation to pay cash. I paid. For the equity, there is an absence of obligation to pay cash. Like under the equity, you don't have to pay cash. Means if you have got a share which is mandatorily redeemable. Mandatorily redeemable means you have to redeem it at any cost. So this is not going to be equity. This is a liability. No matter you call it even equity share, it's not equity. So the major thing is that your basically obligation to repay cash. That's what it is. Do you get it now?
Yes. Got it.
You have any other query, Lasana?
Impairment of financial assets.
Sorry?
Impairment of financial assets.
Yes. What is it that you want to know with respect to that?
The 3 stages of when to recognize a loss allowance.
Okay.
Stage 1, stage 2, stage 3.
Okay, let me just guide you.
Yeah.
I have a video also on that, which I'm going to share because there are certain videos which I should be sharing after the class. Now, number one point is that basically you know that there is this expected credit loss approach that we adopt. I bet you know that there is an expected credit loss approach that we adopt. Now, if case number 1, insignificant increase in credit risk. Number 2, significant increase in credit risk. Number 3, objective evidence of impairment. Now let me just guide you. Stage 1, 2, and 3. Now, let me just explain to you. Basically, the 3 stages of impairment of financial assets are like this. First of all, you need to understand that we adopt an expected credit loss approach. What do you mean by adopting expected credit loss approach? The adopting of the expected credit loss approach means that we recognize the impairment loss on the basis of expected credit loss. We recognize the impairment on the basis of expected credit loss, that how much is the credit loss we are expecting to arise. Now, so for example, if you acquire a financial asset and there is an insignificant increase in credit risk over time, so that means it's a stage 1 of impairment and you should recognize a 12-month expected credit loss. Means the likely default within the next 12 months. Then if there is a significant increase in credit risk, then what you should do is that you should recognize lifetime expected credit losses. The third one of them is basically an objective evidence of impairment. What do you mean by objective evidence of impairment? Let me just guide you about the objective evidence of impairment. For example, if there is a default in the payment that has actually taken place, the payment has not been received by you. So if there is a default in the payment that has taken place, that means the payment has not taken place on time. So that's an objective evidence of impairment. So under the objective evidence of impairment, we recognize actual impairment loss. And once the impairment loss is recognized, the future interest is established on the basis of net carrying amount. So like maybe possible, just try to understand something that under this, let's say the financial asset was originally for 100,000. What would happen is that you would recognize, let's say, loss allowance under stage 1 and under stage 2. Let's say if the loss allowance is 5,000 or the loss allowance is 22,000, whatsoever that is. So what happens is that the net amount is 95,000. The net amount is 78,000, right? And subsequently the interest income is going to be on 100,000. But if it was impairment, so let's say the financial asset was 100,000 and if there was a loss allowance or impairment of 22,000, so the net carrying amount is going to be 78,000. Now the interest would be on this amount. Now the interest would be on this amount. 78,000 is what the interest is going to be on. Right? Do you get it now?
Yes.
Okay. What other query do you have?
I don't have any at the moment.
Nothing?
Nothing yet.
Okay, good enough. So all the best with your exam preparations.
Thank you.
Okay, Dilian Fernando, you have any query? Dilian Fernando, do you have any query? You're welcome. Okay, we have got Bolu Watafi Orika. I'm sorry if I'm pronouncing your name incorrectly, but I can see you have message 1, which is Sale and Leaseback under IFRS 16. I'll just message immediately after the class this sale and leaseback. I've got a short video on that, which is about the sale and leaseback. So I'll just share it immediately after the class. You have any other query than this?
No, I don't. Thank you very much.
Okay, how is your preparation? Okay, lovely. I've got Beatrice. Beatrice, you have anything to ask?
No, at the moment, I'm writing in June, so I'm still studying steadily. Thank you.
Okay, lovely. Thank you. Anna Razak, is there anything that you would like to ask? Okay, lovely. So thank you very much, guys. Thanks for your time and thank you for attending the session. It was nice to have you people in here, and I wish you all the best with the preparations. The recording for this session plus some other committed recordings would be made available to you probably by tonight, inshallah. So thank you very much. Thanks for your time.